Why are dividends so powerful? And why does everyone talk about passive income with dividends? Well, we're going to discuss that so you can understand the power of dividends. We're going to discuss how dividends are calculated, how you can find them, how they're taxed, and then ultimately so you can see why they're so powerful. But first, I'm not a financial advisor and this is not financial advice. Take a quick look at my channel and then we'll get into it.
So take a look at the playlist page for Hack Your Finances. You can obviously subscribe at the top. Playlists to get out of debt, credit cards to use to your advantage, and investing for passive income. At the bottom, we've got a 6-lesson series to help you get out of debt. Thanks for watching and supporting the channel.
All right, so first we're going to start with a stock. The stock will be Verizon, and as you can see here, I'm going to throw it up on the screen. We're going to focus on 3 things. The share price, which is the price of 1 share of Verizon as of the day I took the screenshot, because it can change every day. Then we're going to look at the dividend and the yield, and then the ex-dividend date. Now what's important to note here is the dividend and the yield and how that's calculated. A lot of people are a little fuzzy on how this works. So the stock is Verizon, and as you just saw, it's showing a percentage rate of 6.63%. Now this is the percentage rate. You must understand it's calculated based on the share price. So as the share price changes, this number will change. Now what does this really mean? It showed 6.63% and it showed a dividend per share of $2.66, both of those numbers. They matter. What matters here is the share price and the dividend per share. Let's first talk about what does it mean when you're getting 6.63%. Well, for every $100 that you invest, you will make $6.63 per year. That's ultimately what that yield's going to be on the $100 that you invest. Now, how did they calculate this number? It's important to know, and I'm going to keep stressing, it's calculated. So if you were to buy Verizon today at that price, you'll get that rate. If I were to buy it in the future, it may be different, and I'll show why in a second. Here's how you calculate it. You look at the dividends per share, and they say $2.66. That means for every share of stock that you buy, you will get $2.66 over the course of a year. They happen to pay quarterly, which is every 3 months. So you'll get 1/4 of it. 3 months later, you get 1/4 of it. 3 months later, you get 1/4 of it, etc. And they have dates that they pay out on. So to calculate it, you take the dividends per share, which is $2.66. You divide it by the current share price, which right now is $39.77. And you're going to get, when you divide it, 6.63%. All right, very important to note. Now I'm going to explain why this matters and what you have to understand so as you look at it in the future, you'll know what you're looking at. Now to further illustrate exactly how the dividends are calculated, let me explain 2 different things here. First this, and then we'll get on to the second example. We just said on the prior page that you received $2.66 was the dividends per share, all right? We divided that by the share price that you paid, $39.77, and that comes out to be a dividend yield of 6.63%. That's what you got. That's what you're getting. That's calculated on the share price, dividends per share. I come along a month later, 2 months later, I buy the same stock, but it costs me not $39.77, it costs me $50, all right? It's still $2.66 dividend per share. Now, I paid $50, so I'm dividing by 50. I'm going to get an effective yield of 5.3%. You and I have a conversation. You're excited because you're getting 6.6% on the money you put into Verizon. And I say, well, that doesn't make sense. You're not getting 6.63, you're getting 5.3. I just looked at it online. It says 5.3. Aha, I'm wrong. I'm wrong because you are getting 6.63. Because you bought it at $39.77. I bought it at $50. So this price will change. Now the earnings per share stayed the same. Okay, but since I paid more, I'm getting effectively a lower rate of return. because I paid $50 for my share. I put $50 in, you put $39.77, yet we're both getting the same amount of money out. So I put more in to get that money, you put less in to get that money. So you're effectively getting a higher yield. So I hope that makes sense. That's important to note because it will change. You might look and say a year from now, look at Verizon, it went up in price. And you say, oh my goodness, I'm only getting 2% on my money now? That's not good. No. You're still getting 6.63 on what you put in because you're still getting that earnings per share. Okay. Now to illustrate it further, take a look at this. Let's say you bought 2 shares at basically $40. All right, so the total price you paid that you put in was $80. Think of it like you put $80 in the bank and you got a yield. All right. And we said the yield was 6.63. So over the course of that yield, you're going to get a total of $80 times 6.63. Turns out it's $5.32. But that's not how it's calculated. It's calculated because you have 2 shares. And you get $2.66 per share. So 2 times 266 is 532. This is how you calculate. Okay, not this way, because that's what you originally put in. So forget this method, even though it works out to be the same. Let me show you what happens. Okay, so here we are in the future, and the stock price went up. It's now worth $80 a share. You look online, and you think, or you look at your brokerage account, and you see that your 2 shares are now worth $160. And you think, oh, that's great, because I'm getting 6.63%. So if it's worth $160 and I multiply by 6.63%, I must be getting $10.60. No. You're still getting 2 shares times 266, which equals $5.32. Because that's how you calculate it. You don't multiply it by that rate that you remember you had originally. Okay? Now, you might think, well, that's terrible. That means I'm not making as much on my money. Well, no, you're still making the same because even though it's worth $160, you only paid $80. Remember, that rate will always be calculated, if you want to use the rate, on the money that you originally put in. So forget that calculation and always do it based on the shares. What is the earnings per share? They can change the earnings per share. They can change the dividend amount. But assuming it stays that rate, it's 2 times whatever the earnings per share is, regardless of what it might currently be worth. Hopefully that makes sense. Basically, just remember it's always the number of shares times the earnings per share, and that's what you're going to get over the course of a year. Okay, now let's talk about why it's so powerful. 2 main reasons. First, let's get into how it's taxed. Okay, we're going to discuss 2 different things related to taxes that make it so powerful. Now, this is the first thing, and this is important to note. We're going to talk about the taxes. First, there are 2 words that matter: qualified and non-qualified. All that means is if these stock dividends are considered to be qualified, then you're going to receive a dividend tax rate. I'm about to show you the tax rates, but these tax rates are lower than the non-qualified, which is taxed at your regular income tax rate. So these are lower, these are higher. So we want them to be qualified because we get the better dividend tax rate. So let me explain how you make them qualified. Well, you don't make them qualified, but this is what you have to do. There are 2 dates that we showed on that Verizon sheet. One is called the ex-dividend date. In this case, it was April 9th. Then there was the dividend date of May 1st. The dividend date, May 1st, is when you're going to receive, the company's going to pay out the dividends. It should hit your account on that day. Might be a day or 2 later due to processing or business days versus weekend, but the company's going to pay out on May 1st. In order to get the dividend, you have to have owned the stock before the ex-dividend date. So if you buy it on April 9th or later, April 9th, 10th, 11th, 12th, all the way to May 1st, then you won't receive the dividend. So you have to, this matters for the company. In order to get your dividend, you have to have owned it before the X dividend date. And it usually is around a month, but they post it. So if you're about to buy a stock or you're thinking about it, you're not sure, look, see what the X dividend date is, because if they pay every quarter, you might get one, if you buy it on the 8th, then you're going to get it. You buy it on the 10th, 9th, or 10th, you're not going to get it. You have to wait 3 months. Okay, so that matters as to whether or not you're going to get the dividend. Now, once you've bought it, if you're just holding it for years and years and years, then this doesn't matter anymore. Because this only matters if you're buying it and selling it and buying it and selling it. You have to make sure you bought it before the X dividend date to receive the next dividend. Okay. Now, how do we get, that's how you get the dividend, how do we get the better tax treatment that makes it so powerful? It's got to be qualified. What does that mean? They have this rule. This is the IRS, because they're the ones taxing you. The X dividend date that we discussed is April 9th. So we're going to put it here. That's one day. That represents April 9th. They have this 121-day rule, which is 60 days before the date, X dividend date, and 60 days after the X dividend date. In order to be a qualified dividend, you have to hold it for 61 days. That's what we want. Now, obviously, you don't want to hold it for these 61 days. Because if you bought on April 9th or after, you're not going to receive the upcoming dividend. So if you're buying it and selling it, or different stocks throughout the year, if you want to get the dividend, you got to own it before that date. So if you wanted this to work, you would have to buy it before April 9th. To assure that you're going to get the dividend, you'd have to make sure you own it for that 61 days there, which is the 60 days prior to April 9th. So I guess that'd be like February something. I don't know the exact. I'd have to count on a calendar. February 8th, February 9th? I'm not sure. But you would have to own it 60 days prior, and that's how you would get it. So this is the crazy IRS rule that basically says you got to hold it for 61 days so that you can assure that you're going to get the preferential tax treatment. It's that easy. Just to recap, you got to buy it before the X dividend date to get the dividend. You have to hold it 61 days up to that X dividend date. You have to hold it for 61 days within this 121. This is a total of 121 days. If you read it in text, it'll keep referencing the 121 days, the X dividend date, 60 days prior, 60 days after. So during that time, you want to have it during that. All right. Now, let's look at why it is so powerful. All right, so here we are as to the most powerful part. Now, first, take a look at this chart that's up on the screen. This is the dividend tax rates. As you can see here, it says these are the tax rates that apply to qualified dividends. That's what we've got. Now, it shows you the filing statuses, single, married, filing jointly, etc., and the percentage rates, 0%, 15, and 20. So on dividends, you're taxed in one of these three brackets. As you can see, there's ranges for the amount of money you've made in dividends. It has nothing to do with your salary. This is just what you get taxed on dividends. So we're going to use the example of single up here on the board. Okay, so we're going to talk about the single category. And I just wrote out here, it said this is for dividends. If you make between $0 and $47,000 over the course of a year, in dividends, in other words, let's just say all your money was in Verizon and you got those dividends we just showed, you would pay 0% up to that amount. For any amount between $47,025 and $518, you're going to pay 15%. So in the first 47, it's 0%. You get all that money. And then in between here, whatever that incremental difference is, you're going to get 15% of that. I'll kind of show you an example with the federal taxes. If you're making over $500,000 a year in dividend income, they're going to charge you 20%. But just to know, if you're making over $500,000 in dividend income every year, stop the video. Stop watching it. It's pointless. I don't know why you're here, because you're making a lot of money. Actually, call me, because we should hang out. That'll be a lot of fun, because you're making a ridiculous amount of money. Then, that's dividend income. Now, regular income, as you're probably already aware, this is your, let's say, your salary. For the first $11,000, you pay 10%. Then the next bracket is 11,000 to over 44,000. That incremental amount will be 12%. 44 to 95, 22%. You get the idea. That is the federal tax brackets. 10, 12, 22, 24. Keeps going. I think it's 32, 35, and all the way up to 37% of your income goes to the federal government. And another way to look at that is January, February, March, and April of every year. Every single dollar you make, you give to the federal government because they have important things to do. And then the rest of the year, you get to keep that money. That's another way to look at that. You can see that dividend income is taxed up to $500,000, 15%. Is taxed way less, starting at zero, way less than regular income. So what makes dividend income so powerful is the amount of taxes that you're not paying. So let me give you an actual example. Here is dividend income, right in this column, and here is regular income. In both examples, we're making $40,000 over the course of a year. $40,000 for a single individual fits in here. You pay 0%. $40,000, zero taxes. At the end of the year, you get to keep your entire $40,000. Great. If you made $40,000 as a salary at your job, well, the first $11,000 is 10%. That's $1,100. 10% of 11,000. Then the difference, because now you're in the 11,000 to 47,000, how much is in there? Well, you have 11 at this rate, you have 29,000 at this rate, 12%. That's 3,480. So your total federal taxes, I should say federal taxes, is 4,580. So you pay that. So your 40,000 minus your taxes, you're left with 35,420. So as you can see, it's the same amount of money, but if it's in dividends, qualified, you're going to get to keep it all in this bracket. If it's income, you're going to pay all these taxes, and you're only going to end up with $35,000. It's a $5,000 difference, and as you can see, the bigger these numbers are, because federal taxes are so expensive, it gets even more disparate, and this becomes even more lucrative. And by the way, I did not take out the FICA and Social Security, so this number is actually less. Those are the other taxes that are on your pay stub that the employer takes out and gives to the government. So this is why it's so powerful, and I'm going to show you why it becomes even more powerful over time. Okay, so this is the best part of the video. This is time lapse. So let's say we've got our two columns here, all right? We have our regular income that we talked about, your job, and let's just say that over time you're in that, ultimately the highest bracket is 25%. Then dividends, and that is 0% because that's the bracket you're in. And this just represents that you're 20 years old and you're working, let's say you're working till you're 60 years old. Well, while you're working, most of your income, 100% when you're 20, your income's coming from your job. And then maybe the next year it's 99% and 98%. What do I mean by that? Well, you start investing in year 1, year 2, year 3, and you're buying these income producing assets that are providing you with dividends. So in this first year, 0% of your income comes from dividends. But then this year, 1% came from dividends. And this year, 2% came from dividends and 98% came from regular income. You're still working your regular job, but because you're investing, part of your income proportionally is from dividends. Over time, when you retire, eventually 0% of your income will be from a job because you retired. I quit, I'm out of here, I'm going to go have fun. Dividends go down, down, down. So now all of your income, 100%, is from dividends. Well, we just showed the example that during the time when your income is primarily working, your $40,000 a year is only going to yield you $35,000. You're going to work and you're going to get $35,000. But because you were proactive and you invested, now that you're getting $40,000 a year at a 0% rate, you're going to keep the $40,000. Obviously, it's greater than $35,000, but more importantly, you're not working. That's what's so powerful with dividend income, is that you're now retired. And not only do you have a 0% tax rate, but remember, you're not also taking out things like FICA and Social Security, which was taken out of here. So, over time, the dividends that you're getting are going to be taxed at 0%, and you're going to keep all of the dividends. Of course, that was because it was under the $47,000. If it was a little more, you pay more like 15%, but it's still going to be way less than the federal. So you get to keep all the money you make, and you don't have to work. That's why it's so powerful. Now, a video should have popped up here, and if it didn't, it will in a moment. I have a video specifically showing you how you can retire early based on dividends, how to invest, how to do the math, and how to plan right now. Regardless of your age, you can start saving, you can start buying, and you can start receiving this income at that 0% rate, up to $40,000, of course, and save, get your income, replace your job income with dividend income, and don't work. That's the ultimate goal. Thank you for watching, and I hope this was very helpful. Have a good day.